All right. All right. So we're going to be talking today about how to make money as an apartment syndicator on this webinar. And we're going to be diving into what you can see on your screen there. We're going to be diving into what fees you can charge as an apartment syndicator, what types of equity splits do apartment syndicators typically charge, and then does the syndicator themselves actually have to invest their own money into a deal? And then which fees should you charge if you decide to get into apartment syndication to make sure that you can keep your investors investing with you time and time again? So that's what we're going to cover today. My goal is to keep this to about 25 to 30 minutes, somewhere around in there. And we'll have some time at the end to have some questions, to be able to answer some questions as well. But that's what we're going to cover today. So for those of you who don't know who I am, I'm Dan Handford. I'm one of the managing partners of a group that you can see here called PassiveInvesting.com. And for those of you who are joining us live, I'm going to type into the chat box here this link to the website. In case you wanted to find out more information about myself or our team, you can click on this little button here that says Meet the Team, and you can see our team here. Here's myself. We have two other managing partners, Danny Randazzo and Brandon Abbott. You can click on any one of our photos. There's a bio video there of us talking a little bit about our backgrounds and things like that. And I'm actually, like I said earlier, before I turned the recording on, I'm located in Columbia, South Carolina. I live here with my wife and our 4 children, and we have 3 girls and a boy, all under 10. So we have a 9-year-old girl, a 8-year-old boy, and then a 4-year-old girl, and a 4-year-old girl, and a 2-year-old girl. So definitely a busy lifestyle, busy household in the Handford family. And if you're interested in investing with us passively, whether you're a new syndicator that maybe wants to get their feet wet by investing first, which is what I highly recommend because it's how I got started in this space, is investing passively as a limited partner first. You can go to our website here on the top right-hand corner. You can see this little button here that says Join Passive Investing Club. When you click on that, there's a form that you can fill out that will allow you to be able to fill this form out to be able to jump on a phone call with us to make sure that we are the right fit for you when it comes to investing in some of our opportunities. So you can go to that website, fill out that form, and let us know that you want to join us. And I will mention to you that we are going to have another deal released pretty soon. So if you want to join on that list, you can take a look at that. It is going to be open to accredited investors only. So we are right now only accepting accredited investors for our projects. And so it is going to be a 506 Charlie, which means we can only accept accredited investors. It's actually located in the Raleigh MSA. It'll be our largest deal to date. So the largest deal up to this point was a $51.5 million acquisition. This one's going to be a $57.6 million acquisition. And I would love to have you join us on that project if you so choose. So let's talk about how to make money as an apartment syndicator. So first thing is, let's go through all of these fees that you could potentially charge. And again, the reason why I stress that could potentially charge is because it doesn't necessarily mean that you should charge all these fees. So we're going to go through these fairly quickly and kind of give you some guidelines as to what some of the typical amounts are for these different fees. So first off, is what we call our acquisition fee. Now, that acquisition fee is an upfront fee that is paid by this new kind of partnership entity that is being created. And that acquisition fee is being paid to that sponsor or that operator for finding, analyzing, evaluating, financing, and eventually closing that property, right? So there's a lot of things that happen before closing, and that's what that fee pays for, right? And typically you're going to see that fee anywhere between about 2 to 3%. Sometimes when the deal sizes get a little bit smaller, they might go up to about 3.5 to 4%. And if it's a really, really large deal, like over 100 million, you might start to see that fee start to drop down. But most of the time, you're going to see that fee between that 2 to 3% range, and that is considered a kind of normal or typical range for that fee. Now, the next fee is going to be a fee called a construction management fee. Now, the construction management fee is a fee that is sometimes charged by the operator, but to the group, but many times it's charged by the property management company to oversee the construction aspects of any types of renovations that are happening on the project. So, and that usually ranges between about 5 to 10%. Another fee is the asset management fee. Now, the asset management fee is a fee that is an ongoing annual fee that is usually paid out monthly, and it is typically based off of the prior month's overall collections, the gross income off the property. And that fee is paid to the operator to be able to maintain the asset, to be able to manage the asset on an ongoing basis. So for our group, passiveinvesting.com, one of the things that we use that for, we don't use that fee to kind of put in our own pockets and kind of, make money, if you will. We use those asset management fees to pour back into hiring additional people to make sure that we can grow our team, to make sure we can actually manage those assets properly and effectively and efficiently. So as we start to have more fees come in, we will start to hire more and more people, so we make sure that we're managing and having enough eyes on the assets as we continue to grow. Another fee is going to be a property management fee. We talked a little bit about the property management when we talked about the construction management fee, but there's also a property management fee. Now, it's not necessarily always charged. Most of the time, it's not usually charged by the operator, the syndicator. It's usually only charged by the property management company. But if you choose to vertically integrate and start your own property management company and do all that in-house, then of course, that's another way that you can make some money, is to be able to charge those fees from the property management side of things. Now, I will tell you that the property management fee is a fee that is not usually a fee that you make a lot of money off of when you vertically integrate. It just allows you to have more control over your asset. And typically, depending on the size of the asset, that'll usually be between about 3 to about 6%. Sometimes it's gonna be a little higher than that if it's a smaller asset or no on-site management, but typically that's gonna be between about 3 to 6%, somewhere around in there. Now I'm gonna go back to the asset management fee, because I'm not sure if I mentioned the range there, because I think I might have skipped over that. But typically your asset management fee is gonna be anywhere between about 1 to 3% of that gross income from the prior month. So whatever that gross collections are, then that's going to be the fee that's how you'll calculate that percentage. So if the property collected, $100,000 the month before, then the asset management fee is 2%. Then the operator is going to get $2,000 a month to be able to continue that asset management piece of it. Now, the other fee I want to mention is a refinance fee. And a refinance fee, it can also be called a capital event fee, or maybe even not even refinance, but a supplemental loan. Because a supplemental loan being put on the property, you can also get a fee for that. And that's because there's a lot of effort that goes into getting those types of loans, and it helps to compensate the syndicator for these efforts. And it is, again, a fee that's paid at closing, and usually in the range of about half a point to about a 1 to 1.5% for that refinancing fee. And many syndicators will only take the refinancing fee if during the refinance they can return a certain percentage of capital to the investors, and then that fee will kick in. So a lot of it just depends on that piece of it. So those are, and then of course you have a guarantee fee. So if you have enough net worth and liquidity that you can actually sign on your own debt for these large acquisitions, because you have to maintain a certain amount of net worth and maintain a certain amount of liquidity during the entire hold period of that property, then there's also another fee that can be charged, which is called a guarantee or a loan guarantor fee. And again, that one usually ranges from about 1 to 2%, somewhere around in there. And that's based off of either all of the fees that are included. That with like an acquisition fee, it's usually the total transaction cost, which means the purchase price, the capital expenditures, and any closing costs will be lumped into that, and that percentage will be based off of that. And then same thing with the loan guarantor fee. Some people charge it off of the loan amount, and some people charge it off the total transaction, just like the acquisition fee. And so you can choose whichever way you want to do it to be able to do that. So those are the primary fees, or some of the more common fees that you might see when you're reviewing things. But there are other fees that sometimes syndicators will charge. I know I've talked to a group before that actually charges a broker fee. And first I was like, what is this broker fee on here? And he said, well, we have an acquisitions person who's going out there working with the brokers to be able to find deals. And that's a fee that's charged so that he can get paid to be able to find those deals. And, to me, I thought it was a little bit excessive, but that's another fee that if you wanted to charge, you could. And we're going to talk about here in a minute, which ones I feel like you are the most common ones that are ones that we charge. And so I'll tell you what we do. And I feel like it's the best way to do it because of the level of fees that could be charged, and it can affect the underwriting quite a bit as well. The more fees you have, the more meat you have to have on your deals to be able to allow everybody to be able to get paid and still allow your investor to get a decent return on their investment. So what types of equity splits do apartment syndicators charge? Apartment syndicators will charge, usually the most common one that I see is 70-30. So 70% of the deal is going to the investors, to the limited partners, and then 30% of it is going to the operator or the sponsor for that kind of sweat equity, if you will, for putting the entire project together. Now, some people will go down from there. You can sometimes see it 80-20. I actually was just looking at one today that is an 80-20 split. I've seen it down to 90-10. I've seen 95-5. Now, one of the reasons why we like to do the Zach is asking, are there any slides? No, there are not any slides. So Zach, I usually just go off of what I see on the screen here and our list, and I try to have more of a conversation and kind of, give you the information without having any slides. So no, I do not have any slides, but good question there. So one of the things that you have to think about when it comes to these equity splits, and this is one of the things I really like about the equity splits that we do, is that we do a 70-30 split on our deals, right? And so I look at that, and we've toyed with going to 80-20, and I think I would be okay with doing that. But anything less than that is really, to me, it removes a lot of the cushion for error, if you will. So, and what I mean by that is, if we put a project together and there's a 70-30 split, if it goes full cycle and we're not able to execute and perform exactly as we planned, we can actually give up a portion of our 30% to make sure that our investors are made whole, and they get their originally projected returns if we can get there, right? And so that's one of the things that I like about these types of projects where you have that 70-30 split, is you actually have that 30% as like an extra cushion if needed to make sure that you can protect your investors and their investments. And so hopefully you don't have to use it, but I like it there as like just an additional level of cushion, for the same reason why you might, when you underwrite a deal, expand the cap rate upon exit, because you're going to be projecting conservatively that you're going to be exiting a deal in a softer market and not trying to sell in a stronger market. Now, hopefully you're selling in a stronger market, but that gives you that extra room for error, the extra cushion, and that 70-30 split does that very same thing, as long as you're teaming up with an operator that thinks that same way. There are some operators that are like, nope, it's 70-30. I don't care if we're losing money or whatever. It's always 70-30. And to me, I just can't get there, right? Because our goal with our group passiveinvesting.com is not to just bring on one investor for one deal and that's it. Our goal is to grow our wealth together with our investors. And our goal is to be able to have investors come with us on multiple projects over many, many decades, and not just having these one-off deals. So we want to make sure that we're protecting our investors, and we on our group invest alongside of our investors. Usually between about 5 to 10% of the deal, we're investing alongside of our investors, and sometimes more than that. But that's really kind of what we want to make sure we're doing is protecting the downside and protecting our investors. And that extra 30% there, or that 30% gives us that extra cushion that we want to be able to make it an even more conservative project. Does the syndicator need to invest their own money? So my simple answer to that question is no, you do not have to, or you don't need to invest in each one of your deals. Now, I will say that most investors will want to see you investing. It's one of the most common questions that we get as an operator is how much are you investing in this deal, or how much money do you have tied up? And it's a great question, because one of the things I always say is you want to make sure you're investing with an operator that doesn't mind putting some skin in the game, right? They think that the deal is solid enough, and they have enough financial backing themselves that they can actually invest inside of each one of the projects that they put together. So my recommendation is that you should invest in every deal. And to what level, that's going to be up to you. I personally, if I'm going to invest in a project, I want to see at least $100,000 invested into the deal from each one of the partners that are on the project, right? And I don't necessarily have to have like 10% or 5% or whatever, but I do like to see a at least $100,000 co-investment alongside the investors. And that's the thing that investors like to see, is that kind of co-investment alongside those investors. But you do not have to, right? It just might take you a little bit longer to be able to find some investors that don't mind investing in a project where you're not investing alongside them. But it definitely is a good alignment of interest when they know that you also have money to lose on that. And some of you might be thinking, well, is it possible to roll in like an acquisition fee or something like that into that? Yes, you can certainly do that. And to me, you're going to get, I don't really care if you do that, because you're going to roll that in or you're going to take it out. And if you take it out, I mean, it's still your money, right? You still earned that money. So whether it's rolled in or you completely take it out and put more in or whatever, I don't really care there. But I do like to see that you have some skin in the game when it comes to investing your own money. Now, I'm going to talk to you, this last question is about which fees should you charge so you can continue to keep your investors coming back to you and investing time and time again. So I'm going to go over the fee structure, the fees that we charge, and these are going to be the ones that I would suggest. And if you can kind of stay in this level of fees, then you'll also be able to find deals that will hopefully pencil a little bit better as well. So obviously the acquisition fee is one of the number one things that we'll charge, and then the next fee is going to be the loan guarantor fee, and then we'll have an asset management fee, and then the disposition fee. We don't charge any other fees other than that. And two of our fees are actually performance-based, and which is kind of unique. And so when we put together our group, we wanted to make sure we stood out from everybody else and did things differently. And I would suggest you thinking about this for your own group, if you're putting together a team, is making some of your fees performance-based. So with the asset management fee, it's performance-based in the fact that if for some reason we are not able to make distributions to our investors, then we will not take that asset management fee. Now, we will still hopefully be made whole with that when we sell the property or some future timeline down the road. But if we can't make distributions to investors, we don't feel like it's right for us to take funds off the property as well, because that means the property obviously doesn't have enough cash flow to make distributions. And so we don't want to be getting paid and our investors not getting paid. And so we choose not to take that fee. The second fee that is a performance-based fee is the disposition fee. So in the disposition fee, we only take that disposition fee if we can outperform the originally projected returns for the deal. And so if we projected a 15% annualized return, or IRR, whichever one you're looking at, or target you're looking for, if we hit that 15%, then it triggers that disposition fee, and then the waterfall continues from there. But we did that because a lot of people, a lot of groups, or most groups, will take the disposition fee first when they sell, and then if there's any money left over, they'll give that to the investors from the profit splits. But we choose to want to take care of our investors first, and again, we're always trying to look out for our investors. So we take that money and we put it into a performance structure where we get paid that fee only if we outperform the property, and it's a win-win for all the investors, right? It's a win for us as the operator, and it's a win for the investors at the same time. All right, so I know there's a couple of questions that have come in here. Let me open it up, my Q&A box, and see if there's any questions that are coming through, and I will take any questions from you as everybody types them in here. So let me look them up here. All right. James is asking, that sounds like risk mitigation and management on the sponsor side. Would that be an accurate statement? Rephrase your question there, James, because, he's giving me the context down here. My previous question was about the 70-30 split instead of 80-20. Yes, you are correct, James. So it's definitely a risk mitigation standpoint, and it's on the sponsor side for sure, as long as the sponsor is wanting to or willing to be able to give that up. But when you start to see a deal that goes to 85-15, 90-10, then you're reducing that room for error and that cushion to a point where the deal has to be executed almost perfectly, which we know that usually does not happen. I don't think I've ever been in a deal. I'm currently in 26 of them right now, getting ready to be 29. And between now and the next 60 days, 45 to 60 days. And I have never been in a deal that went off exactly as planned, right? And so it's always good to have that extra cushion in there in the equity splits to be able to give you that extra risk mitigation, like you mentioned there, for the sponsor side. And it also is a risk mitigation for the answers as well. Sean is asking, do you have any deals coming up? So we actually do. We have a deal that's located in Raleigh, North Carolina. It's going to be released on Monday, September 14th. So obviously, if you're one of our investors and you're inside of our investor list, you will receive an email about that deal announcement so you can be aware of it. It's for accredited investors only. It is a 506C as in Charlie. So we would love to have you on that project, or if you want to take a look at it, you can go to our website, passiveinvesting.com, and join our in passive investing club, and we will put you on that list so you can do that as well. So Sam is asking, I reside in Ohio. Is it advantageous to be part of a syndicate within the same state? Is there downside to buying out-of-state property? I think there's benefit to buying property close to you because you can actually be close to that property that you're buying. But I'm not opposed to buying properties out of state either, as long as you have an easy way to be able to be transported there when you never need to get there, right? So I don't think I'm not saying there was really a lot of downsides for buying out of state, other than the fact of the ability to get to that property easily enough. And then of course your local market knowledge of that property as well is something that you want to take into account. So as long as you are well aware of a property that's out of state, I wouldn't be opposed to that at all. So good question. What is the preferred waterfall structure? So typically in the waterfall, you can have a preferred return first. So usually we'll have like a 7% preferred return. Then we'll do that 70-30 split. And then we'll usually have a secondary hurdle in the waterfall where usually around 13-14% IRR. Once we hit that hurdle, the equity splits will change from 70-30 to 50-50. And some people will do it lower than that. Some people do 11 or 12%. Our group has actually done it up to 18% before on certain deals, depending on the return matrix and things like that. That's typically what the preferred waterfall structure is going to be in a syndication. I heard the loan sponsors got a percentage of the GP. How do you use the fee you charge? Yeah, so you're talking about the loan guarantor, John. Yeah, so the loan guarantors will typically get a piece of the GP, a percentage of it, and then they will share in everything else from the GP side. But then they'll also typically, some of them don't, but they'll typically charge a guarantee fee on top of that GP percentage as well, mostly because they obviously have to maintain a certain amount of liquidity and net worth during that entire hold period, and that fee helps them be able to beef up that liquidity position at the same time. Sean, let's see. Thank you, Dan. Do you have any GP opportunity for any of your deals? Right now, we do not. So we are all set from a GP perspective. But I know there's a lot of groups out there that do. And so if you want to join our online Facebook group, you can do that. And we have a post that we do every Monday morning or Monday sometime throughout the day. And you can make a post in there and say, hey, I'm looking to partner with somebody and want to jump on a phone call and kind of meet them first. I went ahead and for those of you who are live, typed into the chat box there, the group for our Facebook group. So you click on that. And you do have to join it and ask a few questions so we can verify you and stuff like that. But once you get in, there's I think right now there's over 6,000, almost 7,000 people that are part of that group. So you can certainly join that group and start that conversation within the actual Multifamily Investor Nation Facebook group, which is fairly active every single week. So you can certainly jump on there and do that. One of the other things that I would encourage you to do too is if you're new to this space and you're just kind of curious a little bit more about some more education around multifamily, we have our Multifamily Investor Nation YouTube channel, and I would highly encourage you to go there as well and subscribe to it. So we have right now just over 3,000 subscribers to our YouTube channel, and we'd love to have you as part of that YouTube channel to continue to see some more of the content that we put out, as well as the weekly webinars that we do at the same time here. Why are you going with a 506C versus a B? So one of the major advantages of a 506c is that you can advertise, right? And you can market the project and bring in investors that don't have that prior existing relationship with you. And so for us, we have a large following. We have over 30,000 people that are part of the Multifamily Investor Nation group now. And that allows us to have that kind of, community where we can actually start to promote the projects that we're doing with that group and bring on some new investors from that. And so that's one of the reasons why we've started to pivot away from doing the 506B into the 506 Charlie. And it also helps us from a compliance perspective. So we don't have to have as much documentation when it comes to a 506C investor versus bringing on the 506B or Bravo investors. So good question there. Let's see. Larry's asking, with the changes to accredited investor status that went into effect on August 26th, does passing the Series 65 exam qualify as an investor, as an accredited? I am not clear on this. I believe it does. And the changes to the accredited investor status was released on August 26th, but it doesn't go into an effect for 60 days after it was released, which is what my understanding is. So one of the things that we are going to do in the future is invite an SEC attorney on to be able to give us some additional clarity. So make sure you subscribe to our YouTube channel and stay connected with us so that you can be aware of that next webinar that we'll have. It's not going to be our very next one, but one of the future webinars we will invite an SEC attorney on to be able to answer some of those questions. But I am almost certain that the Series 65 exam does qualify you to be an accredited investor. So let's see. There's one more question here. Are you finding lenders or either key sponsors or passives are more reluctant due to the CDC or other local eviction moratoriums? No, I have not. So we haven't really seen a lot of that as far as any reluctancy. The deals are still happening. Investors are still investing. We actually ended up raising some funds for a project recently, and it was a $12 million raise on a little bit of a smaller deal. It was a $27 million deal, so a little bit smaller than what we usually go after, at least the last couple of deals. And we ended up raising that. We released it on a Friday afternoon or a Friday evening, and by Monday at midnight, it filled up. So it was a 3-day time frame of actually filling that project up. So earlier in the year, some of those things had an effect, but I think a lot of investors realize that the CDC doesn't really have the authority, I don't believe, to make those local eviction moratoriums. There's a lot of people that are in the National Apartment Association and different organizations that are trying to fight that. And obviously, hopefully that doesn't go into effect. And I know from what our attorneys have said to us, that they are working on that and trying to get that to be able to be resolved. But at the end of the day, the types of assets that we are buying, our group is buying higher quality assets. And so they usually have a better resident demographic in there, and they usually care about their credit. And so because those residents care about their credit, most of them aren't just going to not pay their rent, right? Because even though they might not get evicted, it's still going to affect their credit, right? Because we will file and it will hinder their credit. So the assets that I think will get hurt the most if this continues is going to be those lower end B minus and C class assets that will get impacted and hit the worst when it comes to the local eviction moratoriums. Well, I have one question here from Jason, but I'll have you email me that one, Jason, and I'll be glad to answer that for you off the line here. So be glad to do that. But thank you guys so much for being here. Let me refresh my screen here and see if we have the next week's webinar ready to go. Let me just double check here. There we go. So actually next week, if you see on your screen here, next week, we're going to be discussing the 506B and the 506C security rules and regulations for apartment syndication. So make sure you go ahead and register for that next webinar. For those of you who are joining us live, I'm going to type into the chat box the link that you can go to be able to register for that webinar so you can join us live for that next webinar on the securities rules surrounding 506 Bravo and 506 Charlie. So thank you so much for being with us here today, and look forward to seeing you next week at the same time and through the same platform. Talk to you later.